A future contract, we just mentioned that it's an obligation to buy something or to sell something. If you buy a future, that means you're going long down the line. You're bullish on the asset. So always remember that buying a future, you're bullish. That's going to be real important. Let's take, so if you buy a future on the S&P 500, then you're hoping that it goes up. If you sell a future on the S&P 500, you're hoping it goes down. It's the same thing with with bond futures. With bond futures, you're not betting on interest rates rising. If you go long a bond future, you're betting on interest rates falling. So it's the bond price that you're looking at. So if you go long a treasury future, you're betting interest rates will fall because then bond prices will go up. So the underlying is the treasury bond price, which will rise when rates fall and fall when rates rise. If we go on the FinViz, I don't think I've used FinViz yet this semester, but if we go on the FinViz, they show a lot of the contracts that a lot of types of assets that have futures on them. So you have the S&P 500, obviously, and other stock indices, the NASDAQ 100, Russell 2000 for small stocks, Nikkei for Japan, Europe, the DAX, Dow Jones. You have the VIX. The VIX is the volatility index. We might get into VIX. We'll talk about the VIX some when we talk about options. Then you get into the commodities like energy. We talked about some of these in class. Energy, like oil, gasoline, heating oil, natural gas. Wow, natural gas is well below $2 still. Ethanol, cocoa, cotton. So you get into some of the agriculture, orange juice, coffee, lumber, sugar. Then you get into metals, gold, silver, platinum, copper, palladium. And then you get into cattle, grains, soybean, corn, wheat, rough rice, oats, canola. You have your bonds, long treasuries, intermediate, short treasuries, and then you have your currencies down here. So all of these have futures on them. Many of them have options on them. They probably all have options on them now because of exchange traded funds. So there's a lot of choices, and if you have a strong opinion that something's going to go up in price, then a future is a very efficient way to execute that transaction. So let's use an example of a barrel of oil. So a barrel of oil is what, 30 bucks now. Let's see, what did Yahoo Finance, I mean FinViz say? So 25, 30 bucks, so 25. So you can get a barrel of oil for 25 bucks. So you think oil is going to go up? Wow, these prices are really, really high. I did these notes when oil prices were much, much, much higher. They haven't been 100 bucks in quite some time. But just use round numbers. That's probably why I put $100 in there. The spot price is what you can buy oil for today. So if you went out and said, I want to buy a barrel of oil, let's say that the spot price is 100 bucks, so it would cost you 100 bucks. The future price is 102. So you have a choice. You can buy the oil today for 100 bucks, or you can buy a futures on the oil, which means in 3 months they will give you a barrel of oil and you have to pay $102. Now, why aren't the spot and the future price the same? Well, the spot price is what you have to pay today. It's cash out the door today. The futures price is what you're obligated to pay in 3 months. You don't have to pay anything today. So why don't you just buy the oil today for 100 bucks and sell the futures contract today for 200 bucks and you make $2 in profit, right? You have a locked in $200 in profit and you're absolutely sure you'll make $2. Why is that? Because you buy the oil today for 100, you sell the futures contract, which means in 3 months you will, for absolute certainty, receive $102. So you've got $2 profit. But is that really profit? What if it costs you $1.50 to store the oil? And where are you going to put that oil? You're going to have it in your backyard. If you can put oil in your backyard, then yeah, you could do these trades. So why could you do 10 barrels of oil in your backyard? Your neighbors are probably going to complain, but yeah, you would be locking in $20 in profit by doing that. But if someone's going to charge you $1.50 to store each barrel, then yeah, that $2 profit is just, most of it's just going away. But you also have the time value money, because if you buy the oil today, you're out $100. You could have invested that money for 3 months, and let's say you could have made 50 cents if you had invested that for 3 months. So you got the cost of storage, which is $1.50, and the time value money is 50 cents. It's, you make $2 on the transaction, but it costs you $2 to store and 50 cents. You know, $1.50 to store and 50 cents in time value money. You end up, it's break even. You don't make any money. And that's what we refer to as cost of carry. It's the cost of storage and time value money of buying something today versus buying it on the futures market. Cost of carry should be the only difference in the spot price and the future price. It should be. That should be the difference, because if it wasn't, let's say the future price was $4 and only cost you $2 to store it in time value money, then wow, you should do a billion barrels of oil today at $100, sell a billion barrels for 104. It costs you $2 per barrel, and you make $2 times a billion barrels. You make $2 billion. It's, you know, it's locked in. There's no issue. If that were the case, everybody would be doing that, and it would make markets balance so that that $2 of arbitrage profit would go away. So this futures price should be the spot price plus the cost of carry. That's what it should be. And this is known as Contango. Contango, when the spot price is less than the futures price, that's Contango. So the spot is $1.50 of storage plus 50 cents of time value is $1.02. The future price should be greater than the spot price. So we talked about what if it was 104, you'd have $2 locked in, and you have no risk at all as long as you know for sure that the $2 is your storage. Now if the future price was 98, the future price is less than the spot price, that's known as backwardization. And this does happen in oil markets. In fact, it happens actually quite frequently. So, you know, you could, in this case, buy the futures for 98, which means you've got to deliver oil. You have oil delivered to you in 3 months, and you have to buy it for $98. So you could short oil today for 100, and then buy it back in 3 months for 98, and you lock in $2. And so that does happen. Why don't people do that? Well, how do you short oil? It's interesting. I'm sure there's people looking at oil ETFs and other things, but it's very hard to short. It's easy to buy oil on the spot market, so easy to make the $100 purchase, but it's actually very hard to short oil. Remember, shorting means you're selling something you don't own. And so it looks like an arbitrage, but there's no way to set it up. And the market's definitely telling you something. There's a definite relationship between contango and backwardization and where oil prices go. So a lot of people say, well, the reason the futures price is higher than the spot price is because everyone expects oil prices to go up. But that's not it. You got to think about cost of carry. So the difference in these two, you've got to adjust for cost of carry. And one thing I think is really, really important, if everyone thinks oil prices are going to go up in 3 months, guess what they do today? They go up today. So if everyone thinks oil prices are going up in the future, they go up today. They don't wait. It's not like everyone's thinking, wow, I got to buy, someone wants to buy more oil from me for $100, but oil prices are going up in the future. I don't have any choice. Well, yeah, you do have a choice. You can hold on to the oil if you think it's going to go up. And that'll keep the price from going up, or there's things you can do to protect yourself against that. So it's really hard to say that futures prices are really a prediction of where oil prices are going because of that cost of carry. And obviously this cost of carry can vary investor by investor, both pieces, how much it costs to store it and their own time value as well. But backwardization does exist. So here's an area that you can definitely do more research on, because that word backwardation is such a bizarre word that if you did a Wikipedia look for that, you'd probably find some really good discussion and really help you understand why it exists and what it's telling you about markets. If you're interested in becoming a commodities trader, this is the kind of area you would want to, I'm sure there's textbooks on it and other books on it, but there's terms that you would want to know, like cost of carry, contango, backwardation, that you would be expected to know when interviewing for a job of that type. Futures markets can be used as a very liquid way to replicate the cash market. Another term for the cash market is the spot market. Spot market means you buy it or you sell it today, versus the futures market, you're talking about prices of things that you can lock in, but the transaction doesn't happen until the future. So a good example is if you enter into a oil futures contract for 102 in 3 months, the cash flow today is 0. You may have to put aside a margin. Margin is a big deal. It's important. At USAA, I never really noticed it because my margin, all I had to do was go to the bond portfolio manager. She had $20 billion in assets. And I would just say, hey, Donna, I need $500 million for margin. Can you find me a bond that you're not planning on selling in the next few years that's worth $500 million? It's like, sure, I've got a bunch of them. So margin was never a big issue to me. We would just set them aside. That's just to make sure you're going to be there because you're obligated to buy that in 3 months. And if you go out of business, go insolvent, you can't buy that in 3 months. The person on the other side of this transaction is going to be really upset. So they require you to set aside margin to make sure you can make this payment. But I didn't notice margin at all because I had plenty of assets. It's called hypothecation. I had plenty of assets to hypothecate, assets to set aside as the collateral. So let's say this is based on 1,000 barrels. So that's the notional amount in barrels. Obviously, you multiply about the price of oil, and that gives you the true notional amount. So $102,000. The market value is 0 today. So you don't put the margin as part of your market value. The margin is just asset you set aside as collateral. The futures price, if it goes to 110, the futures price goes to 110. Sorry, boy, my computer. In 3 months, then you get to buy oil for 102. With the futures contract, you immediately resell it for 110. So you made $8,000. What if you'd done this in the cash market? If you'd done it in the cash market, you would have bought the oil today for $100. You had $2 in carry costs. So you purchase it for $1,000. You pay $2,000 in carry costs. So it costs you 102. In 3 months, you sell it for 110. You made $8,000. It's the exact same transaction. Assuming that the futures price exactly reflects your cost of carry, you'll do no differently in the cash market than you'll do in the futures market. So therefore, the futures market is just another way to enter the cash market. It's a very efficient way to do it. It's much more liquid. It's much easier to deal with. And the nice thing about the futures market, if you do this here, that last transaction I showed you, where you buy the oil for 102 and then you sell it for 110, so you buy it on a future, you don't have to do any of this. What you can do in 3 months is, rather than actually executing a futures contract, you can just sell the futures contract back before expiration and you'll end up with the exact same $8,000. You can't do that in the cash market. Now, in the futures market, if you forget you have this contract, boy, you're going to have to, they're going to show up to your house with 1,000 barrels of oil and you're going to have to pay them. And if you don't have a place to put 1,000 barrels of oil, you're in a lot of trouble. So what you'll probably do is the day before expiration, rather than letting those 1,000 barrels of oil show up in your front lawn, you'll instead sell the futures contract back, lock in your $8,000, and you never had to touch a barrel of oil. Versus in the cash market, you actually have to handle those barrels of oil. Now, futures and forwards are essentially the same thing. A future is a standardized contract, very liquid, but what you get for that liquidity is all the terms of the contract are specifically set by the market. Maturity dates, the prices, those are all extremely just exactly worked out, exactly what's available. So it's a very liquid transaction. There's no default risk. There's really no counterparty risk on this because you're dealing with organized large exchanges. And so it's a safer transaction, but you're limited in what you can do because you have to follow exactly the rules of the exchanges. Forwards, which include swaps, are over-the-counter transactions. They're a liquid transactions is usually between you and some investment bank that they're setting up this contract just for you. You can get out of them, but they're not as liquid. Although I found the interest rate swaps I did pretty easy to get out of, but they're not going to be as liquid as, say, a future. Um, and you do this because first you have more flexibility. The first interest rate swap I did a zero coupon 30-year interest rate swap that had a 5-year maturity. That was I didn't even know something like that existed. It was much more flexible for me. I really liked that a whole lot better than anything I could have gotten in the futures market. So you have a lot more control over the transaction. But forwards and swaps are done between between a sophisticated buyer and seller, usually very, very large companies with large notional amounts, billions of dollars usually. Um, they're less liquid, and you pick up counterparty risk. So when I did the interest rate swap, my two counterparties were JP Morgan and Morgan Stanley. And in 2008, I wasn't worried about JP Morgan going under. If JP Morgan had gone under, the whole economy was going to collapse. But I was very worried about Morgan Stanley. If something happened to Morgan, remember that swap was worth $500 million, probably half of it with JP Morgan, half of it with Morgan Stanley. If something happened to Morgan Stanley, there was collateral set aside, but they may not have had enough collateral to cover the entire $250 million. And so I had exposures, so that made me very nervous when Morgan Stanley was on the cusp of going under. As I mentioned before, most futures contracts are settled in cash. That's true with options as well, as we'll see. Not physical delivery, but if you forget you have a futures, there is a whole industry out there that delivers these things. I've never seen it. I don't know exactly how it works in practice, but yeah, you will have that oil or those oranges or those live cattle, whatever you bought through the futures contract, they're going to show up on your doorstep if you don't get out of that contract fast enough. Most futures are used for hedging in some way. There are speculators, obviously, in futures, people trying to play markets. A lot of exchange-traded funds, I'm pretty sure, use futures. Some of them might use swaps and forwards, and there have been some articles that exchange-traded funds that have interest rate swap or have swaps and forwards in them have tremendous counterparty risk that should be a concern for an exchange-traded fund investor. So that's futures. Not my favorite thing in the world. Swaps are pretty close to my favorite thing in the world. I really love swaps. Wish we could talk about swaps some more, but take Dr. Beckham's class or my risk management class, and you'll get a much better overview of those. All right, so that's it for this class. What we'll do next class is my absolute favorite, which is options. I love options. I use them all the time. So what we're going to do with options is I'll give you the definitions. We'll walk through a call versus a put. We'll talk about what impacts their value, and then we're going to spend a lot of time looking at different option strategies, and we'll see the last question on the final exam is going to be looking at options. We're not going to be pricing options. That's a really technical term. What we're instead going to be doing is valuing the option strategy and looking at protected puts, covered calls, collars, straddles, strangles. So we'll look at some of the most popular strategies. I might throw in a few other interesting ones out there if we have a little more time at the end. All right, so that's it for today and for this class.